Hi, it's Dave. Welcome. Today I'm joined by Tim Bixby. He is the CFO of Lemonade Insurance. I wanted to invite you and welcome you to the channel, Tim.
Thanks, Dave. Great to be here.
Yeah, I'm excited. I wanted to do a deep dive onto Lemonade's financials, kind of go into the unit economics, the product lines, growth plans, and really kind of get the essence of what's going on. But first, I wanted to give you the opportunity to share kind of your background. I know you've been the CFO for LivePerson and Shutterstock for many years. How has those experiences shaped you or given you kind of the background and tools to help Lemonade kind of in its current times?
Sure. Yeah. So I've been with Lemonade for about 4 years, and I'm CFO and get to do all the pretty traditional things, but plus some untraditional things that the CFO gets to do in like a hyper growth environment. I've done it a couple times before with different companies, but always in New York City in companies going from small to big, at different paces. We usually in sort of hyper growth mode, and making that transition from private company to public company. I've worked through the process of prepping three different tech companies, including Lemonade, to make that transition from private to public. And what I've kind of found is the CFO role, in my view, is the best role, is the most exciting role. And I think, while founders and CEOs kind of get the glamour and the pressure, there's something about being at a little bit behind the scenes, but also in the middle of everything. Guaranteeing or trying to guarantee that the companies can make it to the next step, whether it's hiring that next person or raising capital or hitting the next milestone. The financial role in companies at this stage is particularly energizing because it's a little less about accounting, even though that's there and that's important, and much more about just blocking and tackling and building. And the thing that I think I finally figured out, and that was really crystallized a bit at Lemonade, is the thing that I found I really enjoy and am, I hope, getting pretty good at, is enabling founders. And what I found is, and you know this as well as anybody, founders are unique animals. The really strong, energizing, successful founders just bring to the startup world something unique, and the clearer that vision and the better they are at execution and kind of sharing that vision, typically the better they do. And what I figured out is I can support and complement that effort and maybe help that vision get to the market faster and get to customers faster. And that's kind of the background. I've been doing it for about 20 years. I've been in New York City on the East Coast the whole time. So I'm near Silicon Valley, but not in Silicon Valley. So I have a little bit of a different take on it. But the thing I've learned is that if you can kind of carefully choose those founders, and you can't always choose their skills and what they're good at and what they're kind of struggling with. But if you can choose good founders and kind of get on that team, then it's a great place to be. And Lemonade, I think, has really proven that to a whole new level.
Yeah. I mean, it seems with Lemonade, your role as a CFO, it seems like because it's so intricately involved with finances and business model, unit economics, it seems like you would be kind of the glue that kind of almost brings things together in terms of the product vision, but merging it, connecting it with the actual numbers, the actual like deployment, how everything goes. I mean, do you kind of see yourself in that role where you're kind of like the mediator between in the company, a lot of times just making sure the product and vision, gets to execution in the right way?
To some extent, yes. I think we're at Lemonade. We're blessed with some pretty clear thinkers and communicators, and so it's less of a need for me to support something that's already I think working really well in terms of communicating a clear vision, energizing employees, communicating to customers, communicating to investors and potential investors. But I think where you're headed is exactly right. Where picking the right words and terms and metrics and where to emphasize and where to de-emphasize is really important. And I think one of the things I think we've learned, just particularly over the few quarters since we've been public, is that the work we put in and invested in choosing those metrics and how we describe the business and how we bridge from traditional insurance, where there's a lot of terms and jargon and things that are important in understanding the mechanics of the business, to the world we want to be in and the world our customers in, which is a technology world and a digital world and a social media world. That's a big gap. And so I think an area where I helped a bit and helped really hopefully energize that bringing those two worlds together is in those metrics. What are the words we use? When do we talk insurance? When do we talk tech? When do we talk just plain simple language? So a lot of it, I think you're right. It's around that language. And then from an investor standpoint, we've got some really thoughtful, sophisticated investors. And what we're learning is that it's not institutional investors only who are thoughtful and clever investors. It's every investor, retail investors, new investors, younger investors have, I think, brought to us thoughtful insight about how they're thinking about the business, how they'd like us to think about the business, what they're understanding, what they're not understanding. I think we as a team have learned as much, in the past year in new vibrant markets as I think I've learned in any year in my 20 or so year career in doing this kind of work.
Mm-hmm. How were you introduced to Lemonade, the company in the beginning, and how has the experience in terms of values and culture in Lemonade been different than your experiences at Shutterstock and LivePerson?
So Lemonade's a unique animal, and every startup's unique in its own way. And by definition, the reason startups exist is because someone has a unique vision they want to bring to consumers and users. I actually was looking for a new role, and I looked for quite a while. I had left Shutterstock. I actually took a year off and promised myself, over my career that someday I was going to try and do it, take a year off and kind of reassess, look at opportunities and look pretty carefully before I jumped into the next thing. And I actually pulled it off when I left my last role at Shutterstock. And I looked at a number of things, lots of really interesting roles, primarily in New York, really impressive companies, and lots of them you've heard of and are familiar with. And because I wanted to take some time off, it was easier to say no than to say yes. And what I found was when you want to say no, it's easy to say no. And I got to a point where when Lemonade came along, I looked as hard as I could. I couldn't find anything that I didn't like. Lemonade came at the market in a unique way, and it was a couple of things. And I think you're probably seeing some of these or most of these. One is the sheer size of the market is extraordinary. One of the struggles of a successful startup and a tech-enabled startup is the better you do, the closer you get to tapping out your market. And so it's kind of this contradiction, right? Where if you're wildly successful, which can happen sometimes, and I've actually seen it a couple of times where things are going really, really well, you start to see the end of your market coming a little bit closer. And that can be scary. And that pushes you to make sure you're expanding your market, expanding your TAM, expanding your product line. In insurance, it's about as unlimited as an industry can be. And so that was one thing that I thought was super interesting. The second thing was the clarity of vision. Two really impressive folks who hadn't worked together before, our founders, Shai and Daniel, coming at an industry with a blank sheet of paper. That was kind of a wow. And with further reflection, the thing that really jumped out at me is lots of people have looked at this industry. You've got large incumbents who are looking at it carefully every day, and they see the world changing and they want to change. And then you've got other folks who might be looking to start businesses or looking to launch something new. They have tended to shy away from insurance. It's a little complex. It's highly regulated. There's lots of scary stuff. It looks like it takes a long time to get anywhere. And those are the things that made Shai and Daniel say, that's what we want. We want to choose something that's very hard and come at it in a radically different way. That was super impressive to me. And that's what really, when I was looking at different opportunities, I kind of stopped dead when I got to Lemonade and got to know Shai and Daniel.
What stage was Lemonade at when you first joined the company about 4 years ago?
Well, in my mind, it was a little further along. When you have those conversations with founders, things look pretty amazing. And I kind of envisioned this, team of hundreds. It was about, I think, less than 40 people globally. A little small team in New York, small team in Israel. So, thousands of customers, some revenue, some premium, and a team of, just a couple of dozen, just a few dozen
Got
when
it.
I.
Yeah. And now, you guys are what, at about 400 people, is it? Or what's your employee
We're
count?
past 600
Oh,
now.
600. Wow. Okay.
So we roughly doubled at year end. That we just reported about five,
Okay.
just under 600. So today we're about 600 people.
600 people.
Uh-huh.
Where does that break down? Like, what percent is in, let's say, product development, R&D versus, let's say, marketing versus,
Sure.
customer service, et cetera?
So I would think of it in sort of rough strokes. About 25% of the people of the headcount are product and R&D. So the folks who build the product, write the code, deliver that vision that the customer sees and feels. About 25%. And then something less than 50%, 40, call it 40 something percent, is customer facing. So though much of our operation is automated and very data and technology driven, we do have human folks who support customers through a customer experience team and a claims experience team, a claims management team. And so that's a little less than half of the headcount. And then the remainder would be sales, finance, legal, and then all the compliance that's required to manage a fully licensed insurance operation.
Okay. And the headquarters is in New York, correct? And then you guys have another big office in Israel, right? Is it Tel Aviv?
We do. So we have
Okay.
four locations worldwide
Okay.
at this point, and the two larger ones, they're actually about three roughly equivalent. So Tel Aviv, New York, and Phoenix, Arizona. So in Scottsdale, just outside Phoenix. So those are roughly equal in size. And then we have a somewhat smaller hub of a couple of dozen folks in Amsterdam. And Amsterdam supports our European operations, along with a bit from New York and Tel Aviv. And that makes up the whole global footprint.
Okay, perfect. As CFO, is there like one metric or one number that you think is by far the most important? Like, let's say, if you could only look at one number and all the other numbers were hidden from you, and you could just follow one number every day or every week, what would that number be for you as CFO of Lemonade?
It's a tough one. Choosing one. It's funny. I think it felt like we spent a year and a half choosing our handful of metrics that I think are pretty good. If we'd had to choose one, it probably would have taken longer. I would answer it this way. There has to be a balance, and so you can't choose one. And if I had to choose the one, it would probably be the one we've chosen as our primary metric, which is in-force premium. That is the measure of the value we're creating. More premium coming from a customer on an annualized basis. So that's the definition of in-force premium, the annualized premiums that a customer pays to us, because that really represents that number and the growth in that number over time, our expanding footprint. It's the protection that customer has over his belongings, and they're paying us a small portion of that so that we can cover their claims. And it represents customer growth, premium per customer growth. It represents product diversification. All those, I think, are captured in that in-force premium number.
Okay.
And then to maybe hedge the question, to kind of push it back to you a bit, is I would really be remiss if we didn't say that customer satisfaction or net promoter score wasn't also critically important, because that tells you how customers feel about what they're buying. Because you can be growing and generating income and profit and those good things over time, but how a customer feels about what they're buying and how they talk to their friends about what they're buying and how they think about what's going to happen when renewal time comes, that's really much more captured in net promoter score. And so that's something we track very closely, but also very proud of. It's in the 60s or 70s or above, and it has been consistently almost since day one of the business. And that's very rare and is multiples of what you typically see in the insurance business. So I'm cheating a little bit, but I'd have to throw those two in there, and then there's a few more after that are important.
Yeah, great. For those who maybe might be new to Lemonade and the insurance business, I'll go ahead and try to interject and try to clarify some terminology so that people are on the same page. So in-force premium. So when a customer pays, let's say this month's premium, you basically times that by 12, right? So you take all of the customers' premium that they're paying this month, and do you times it by 12 to annualize it, or how does that work?
Well, so in insurance, insurance policies are typically 1-year policies, 12-month policies. Sometimes people pay for those once a year, sometimes twice a year, sometimes monthly or 12 times per year. So regardless of how often they're paying, yes, we take an annualized premium, and that the total of that for all of our customers at any point in time would equal our in-force premium.
Mm-hmm. And at the end of Q4, that was what, $213 million of in-force premium? Okay. And then you have a gross earned premium, and that is basically for that quarter in Q4, I believe you had about $50 million in gross earned premium. So that's the premium that you're collecting on that during that quarter, basically, correct?
That's right. And now earned, it's probably worth spending a moment on this. So earned premium is an accounting term. So the earned portion is the portion of the premium that you earn in that period. So for example, in Q4, when we report fourth quarter results, the amount we earn is 3 months worth of the premium. And so that's a GAAP accounting term, and that's a little bit different than the in-force premium that we talked about.
Got it. And then Net Promoter Score. So for those who aren't familiar, or who especially aren't in the tech industry, who has kind of pioneered this Net Promoter Score, can you explain a little bit further where, do you guys do surveys, and how often do you guys do surveys? So I'm guessing it might be probably a typical 1 to 10. How much would you recommend Lemonade product to your friends and family or acquaintances? And what's the process? How do you kind of do the surveys? And then is it typical they have to do 9 or 10 out of 10 in order to be considered a promoter? How does that work?
That's right. So it's a very traditional use of the Net Promoter Score sort of scoring mechanism. It's a scale where we're asking our customers, what's their opinion? Would they recommend our product to a friend or a family member? And the response they can give is strongly agree or strongly disagree. And you're right, it's a rating of 1 to 10. 9s and 10s are counted, full credit. But a negative score, a low score counts against you. So it's a very rigorous scoring mechanism. The net impact of all the math is the scale result number can be anywhere from negative 100 if you get all low scores to positive 100 if you get all 10s. So it's a plus to a minus 100 scale. In this insurance, fairly low relative to that score. It's not uncommon to see score 10 or 20 or those ranges in insurance.
Mm-hmm. Yeah. How often do you do these surveys? How are you collecting the data in terms of satisfaction?
We're doing it almost on a real-time basis. So we request, we kind of share this question consistently and often. And so we're getting, if not on a daily basis, but almost on a weekly basis, a constant update, both for customer support, which is our customer experience group, as well as on our claims management group. And in fact, it's interesting. We even collect Net Promoter Score for claims that we decline, that we deny. And from time to time, we'll decline or deny a claim. And it's often because it's something we don't cover, or it might be below the deductible, or some issue that we help to educate users of why it might not be an appropriate claim. But even in those cases, we're getting fairly positive Net Promoter Scores in what can be a negative experience. And that's a key part of how we want to deal with customers, even when there's a bad news to deliver, and on occasion a claim is not covered. We're still doing that with empathy and clear communication.
Yeah. I mean, with Net Promoter Score, I mean, yeah, 60 or 70 is quite amazing across, almost any product. A lot of companies, in the tech industry have really centered their strategy around the Net Promoter Score. Like one example is Zoom. It's kind of a very high Net Promoter Score. Has really shown like the value of that. But in terms of legacy insurance companies, do they even know about this? Like, I don't say no, but do they care about this, metric at all? I mean, it seems like more like a tech-centric kind of, Silicon Valley kind of, metric, Net Promoter Score. I mean, how broadly accepted is it in the insurance industry?
It's perhaps more broadly accepted than you might expect. It is something that's captured and measured. It's been a struggle in many cases. I mean, it's one of the attractions of the insurance sector to us and to our founders was this very thing. It was very common and is still very common that a customer's experience with insurance can be negative, that their willingness or likelihood of referring business, their provider to others is relatively low. And so it is a kind of a known thing. And having a Net Promoter Score that improves is always something that most of our large incumbent competitors think about. But it has been more of a challenge, particularly when you're using data or technology that may not be as current as something that we're able to provide.
Mm-hmm. Net Promoter Score, do you track it pretty much like week by week, how it changes, or how are you
Sure.
keeping your eye on it?
We do. We track it on almost a real-time basis. We talk about it in weekly updates and monthly town halls to the whole company. It's something we're very focused on. Everyone in the company is aware of its importance. And it's been of all the metrics I think that we track, it's been one of the ones that's notably high and notably consistent over years.
Okay. Has it been consistent over the past year or 12 months or so?
Yes.
Okay. So would you say around 70 or between 60 and 70?
Depending on the interaction, it's typically 70 to 75.
Okay.
And then if you look at declined claims, that can be somewhat lower. That could be in the 40s or 50s. And then sometimes in claims, so for example, we recently had a high density of claims in Texas, where there was the freeze, as you're probably aware. Yeah. And so we tracked very carefully, even in an occurrence like that, where we've got thousands of claims in a very short period of time. We're tracking Net Promoter Score, and the result, even in an instance like that, where people are really under unique intense pressure with the weather occurrence like we had Net Promoter Scores in the 60s.
Yeah, interesting. I'm wondering, let's say, moving on, I guess, I'm wanting to go into kind of the product line to kind of understand, Lemonade, what kind of products you're offering to customers. Your first product line was renters insurance, and both you and Daniel, the CEO, have both commented that renters insurance was kind of like this unloved category, and it kind of seems like almost the perfect kind of first entry point. Can you share how important it was for Lemonade to start with renters insurance and what that enabled, how that helped Lemonade in its growth?
Sure. It's interesting to note, when we launched the company, on day one, we were selling renters, condo owners, and homeowners insurance. So we designed the business from day one to deliver all three of those product types. Now, they're very similar product types in the insurance industry. In many ways, they're grouped together for some purposes. But from day one, we provided all three coverage types. Fairly quickly, we learned that to manage our risk and manage the scope of growth of the business in a smart way, because we had relatively few customers, not so much data, we were a new market entrant. We determined that we should dial back our homeowners sales and let our renters sales grow significantly. That was the place where we found that not only was it an unloved market, meaning there's a lot of greenfield opportunity. Most renters in the U.S. Are required to have insurance, yet many, if not most renters in the U.S. don't have renters insurance. And so it's a required thing from most landlords, but it's seldom policed. And so it's an area where we believed, and turned out to be true, with a great product, with an amazing workflow, a great, fast, simple experience, we could gather a lot of customers and a lot of data quickly and learn quickly. And that's in fact exactly what happened. And so we were able to bring a product to market that was significantly less expensive than competitive products for the same coverage. But it wasn't because we were underpricing or selling at a loss. It was because our cost of distribution is significantly less. Because of the nature of our product, because of the essentially 100% algorithm-driven selling process. It's all bot-driven. It's all digital customer acquisition. We were able to acquire customers that were, in our view, we'd expect to be profitable, even at a much lower price point. And so what we found was, in many cases, our price point for renters insurance was 50 or 60 or 70 or even 80% less expensive, apples to apples, than competitive offerings. And again, it wasn't because we were underpricing or establishing a loss leader approach, but it was because our cost of distribution is and was significantly less. It was an excellent way to enter the market. In a market that's unloved, you don't have quite as much focus and competition. And I think at first, the probability that folks wouldn't really notice what we were up to was pretty high. And then over time, the ball really started rolling. The customer count grew, the premium grew, the data that we're collecting, because we collect so much data per customer interaction, the data really started to grow. And that is what really started the flywheel turning and enabled us to slowly increase that throttle on homeowners. And then we've begun ever since, for the last 2 or so years, have been gradually increasing and shifting that new customer acquisition, so that now we're acquiring customers that are renters and significant number of condo owners and significant number of homeowners, plus the new products that we've launched since.
Mm-hmm. Do you ever break down like what % of your customers are renters versus condo and homeowners at all? Like, is there any sense of like what the comparison is? I mean, I'm guessing renters is by far the bulk, right, of the policies, right?
Yeah. So I mean, if you think about it from a customer count standpoint,
Mm-hmm.
renters are the vast majority, more than 90% of the customer base. But if you think of the price point and the wide range of the value of each customer that's coming to us, then you can see how that in-force premium, or the dollar value of those customers, has begun to shift. So today, even though more than 90% of our customers are renters, something like 30% or more of the new dollar premium coming in is coming from homeowners. And that's been a gradual shift. 3 years ago, that number was about 5%. Now it's more like 30%. So over time, we'll start to see our customer base and our product breakdown look more like the market. Mm-hmm. And in the U.S. market, it's something like 90% of the dollars come from homeowners. For us, that's less than 30% today, but that's been shifting fairly rapidly over the past 2 years.
Mm-hmm. I'm wanting to ask about this whole renters insurance entry that you guys did, and the advantages that you guys found, where you guys could, undercut the competition 50 to 70% in price, which sounds incredible for the opportunity. How much of that? I mean, you mentioned that you guys just had such a efficient, lower cost of distribution to get the customers, et cetera. Was there a factor also where the incumbents had just a rigidity, where maybe they didn't care about the market much, and they just had like a high floor of what they're going to charge regardless of, the economics? And was that something that you guys, were able to notice and take advantage of as well?
That's right. And again, with a market sector that's unloved, and if you're a large incumbent and you're not motivated to go after that segment, it's easy to say no. And so what you're describing, we think was quite common, which is because of the cost of the infrastructure of a larger incumbent insurance provider, it wasn't uncommon to have minimum prices. So whether your risk of loss and insurance, that's really what we're protecting against, right? You or I have a risk of loss. And at the lower value points, if you're a renter, you don't have many belongings, and therefore you need less coverage, you're below the cost to serve of many large insurance players. Whether you're $60 a year, $160 a year, or $360 a year, those are all relatively low value points. And so for Lemonade, because our cost to serve, we believe, is less. We know it's less. We have no agent infrastructure. We're not paying commissions to bring in new business. Our efficiency, if you think about how many employees we have per customer or per dollar of premium, those are all very efficient for our business, even at our relatively low scale. And so what we were able to do is price under those minimums. We don't have a minimum. Our minimum is really to cover the loss of the customer, which is really the core of the insurance product. It's not to cover overhead or fixed costs or commissions. Mm-hmm. And that's what really enabled us to go after this market, but with a view that we can make those profitable customers. We were, by definition, we don't want to be selling, you've heard Daniel say it, we're not going to sell dollars for 90 cents. We want every customer that we bring in to be, and we expect every customer that comes in to be a profitable customer over time. And whether that's a renter that never changes, whether it's a renter that grows, which is more common, or whether it's a renter that graduates to a condo owner or a homeowner and buys other policy types, which is becoming much more common. Any scenario that a customer goes through, we believe those customers that we're acquiring will be profitable customers.
Mm-hmm. Do these incumbents, like, for example, Lemonade, you guys have proven out, the model in renters insurance as something that, you've proven that you can have a great product, a great experience, offer a great price, and grow customers. Do the incumbent insurance companies, have they taken notice and have they adjusted, for example, their minimum prices with renters insurance? Are they, making things more competitive at all? Are they bidding up, for example, paid marketing channels for renters insurance at all? Are they taking notice? Have things changed over the past, let's say, 2 or 3 years with renters insurance? And if so, how?
They've certainly taken notice, yet I wouldn't describe radical change. There have been changes at the margin. I think from a notice standpoint, we've seen clear data points here and there. We're probably one of the more copied businesses out there in terms of our approach and our branding, and so that tells you that somebody's noticing when you start to see things that look familiar. I think the language we use to speak to particularly younger consumers or more digitally savvy consumers, folks that are looking for a unique insurance experience, I think we're quite good at it, and we use a certain language and approach and a simplicity in a complicated business, in a complicated sector, and that really resonates with users, and that has not gone unnoticed. And so we've seen different aspects of our approach copied, but it's hard. It's hard to pick one or two of the things we do well and just isolate that thing and copy it and be successful. And part of that is really our design. We have chosen to do a multitude of things that in aggregate create a better experience. It's not just the data, it's not just the product, it's not just the charitable give back, and maybe we'll talk about that a little bit. It's not just the language, it's not just the price. It's all those things in aggregate that I believe we do really well. And the combination of those, I think, are what makes it difficult to copy or replicate. And folks have tried. There have been sub-brands created with creative, names or interesting names. That's one indication that we're being recognized for some of the things we're doing. We recently passed the million customer mark. So I think, we've gone from the point where, if you have a few thousand customers or a few 100,000 customers, you can kind of argue that it's an interesting new thing. But growing at the pace we're growing, passing a million customers, and probably most notably, if you look at a number of consumer review sites, we've risen very quickly from sort of unknown to rated number one in renters insurance and home insurance. And that's not something that I think was widely expected, maybe at least outside of our company, a couple of years ago. So we're definitely being noticed, but it's a struggle, I think, to replicate these things. And that's why we know we're on the right track, and we keep a close eye on those competitors. But thus far, it's been difficult to really radically change the dynamic. We've not seen people, to maybe the second part of your question, we've not seen wild overspending or bidding up, marketing efforts in an uneconomic way. We've really not really seen much of that sort of thing at all.
With the renters insurance market, at least in the U.S., are you seeing signs of slowing growth? Like, is the market getting, of course not completely saturated, but are you seeing signs of beginnings of more saturation with maybe a slowing growth, trajectory in the renters insurance market?
No, actually we have not. Our business profile is changing. And so we're growing at different paces across the product line of the business. But from a market potential, we're just really scratching the surface. If you think of, the U.S. is, 350 million people, 120 million households. We've got a very, very small proportion based on any measurement that you might have. And so we're really just sort of scratching the surface. I think what we are starting to see in our growth metrics is a broadening of the product line. So today, we can go out and acquire customers and premium from one end of the spectrum, a $60 a year renter who pays $5 a month at a real entry level, to a perhaps $6,000 a year homeowner. So each of those is one customer that we've acquired, but a wildly different lifetime value, annual premium value, and everything in between. We've gone from a monoline business where really renters was the vast majority of our business to renters, condo, homeowners. We've recently added pet health insurance. We've even more recently launched life insurance. And so we've got a breadth of product and price points today that is dramatically different than we had just 2 years ago.
Mm-hmm. Do you have like a total addressable market for renters insurance in the U.S. at all? Like a number, customer number count at all? Or how do you view that market in the U.S.?
I would think of it in, again, annual premium, because that's where you can get a pretty good approximation of the market. And that number is in the $3 or $4 billion range. So for us, just over $200 million, less, some subset of that is renters, is a pretty small proportion of that. The homeowners proportion is something just south of 100 billion in the U.S. If you were to add in Europe, we're now in Europe as we have been for a couple of years. That would double that addressable market. So 100 billion goes to 200 billion plus. And that's just in the homeowners renters portion of the market. On top, pet is an additional market, life insurance additional, and then there's other types of insurance beyond that.
Mm-hmm. Interesting. If it's a $3 to $4 billion renters insurance market in the U.S., then I guess if you had something at $100 average premium, that would be 30 to 40 million customers, right? At a $200 per year average premium, that would be about 20 million. Am I off, or is that generally the ballpark, you think, in terms of customers?
I would think of there's a couple things going on there. So in terms of our price point, our average is in the under $200 range for renters only. So 160, 170 moves around, but I think of that range. The average renter in the U.S. overall is higher than that, probably $200 plus. And then there's uninsured renters in the U.S. So remember, something like 90% of our customers are first-time buyers of insurance. And so there's the established renter market, which is the $3 to $4 billion market. There's the uninsured renters market, and we're getting more than zero of those. It's hard to pinpoint, okay, exactly which type of customer you're getting, but that the uninsured renters market roughly doubles that size. So it's important to take that piece into account as well.
Okay. I noticed in your Q4 report, quarter over quarter growth was probably the slowest that I've seen at 6% in terms of the customer count. So you had about 941,000, I think, customers at the end of Q3. And 3 months later, you had a little bit over 1 million. When I calculate 6% quarter over quarter, it seems like a doubling, that would take about 12 quarters or 3 years to double your customer count at a 6% growth rate quarter over quarter. It seems like a slowing down of the customer count growth rate. Can you explain what's going on here? If, for example, renters, you could just acquire as many customers perhaps as you'd like. Did you guys intentionally just not focus on acquiring new customers at a fast pace during Q4, or were there other circumstances that you guys faced?
Yeah, I would think of it this way. So we're not optimizing for customer count. We're optimizing for premium. So and that's really what you saw is because we have the ability to optimize across the portfolio, we'll go where the benefit is. And so we're able to generate more premium from a smaller number of customers. We'll go that direction. We'll deploy that capital in a way where we're acquiring profitable customers and maximizing within other parameters. I'll talk about those a bit, the in-force premium that's in place. And because we now have the opportunity across multiple product types to do that, you'll see these aberrations. You'll see these quarterly fluctuations in customer count growth. So Q4, while the Q4 result was a somewhat lower than the historical quarter pace, I would view that as an aberration, more as a trend line. And again, because we're optimizing for in-force premium, the customer count is more an output versus an input. Mm-hmm. If we were a renters company only, and our only product was $60 or $100 price points, then that Q4 customer count number would have been, I think, a meaningful indicator of something maybe changing that in the trend or the return the business was able to generate. That's not the case because we're able to acquire. If I can acquire 2 more homeowners at 10 times the premium, that's a better use of our capital in Q4 or really in any quarter than the alternative. So over time, you'll see these quarterly aberrations, but our focus is over a longer term view to, again, maximize that in-force premium that we're bringing in.
When did that switch happen to maximize in-force premium over customer count? Like, was there a certain quarter or time period where you guys said, hey, we're going to, prioritize in-force premium over customer count growth?
No, it was not a sudden change. It's always been the primary focus. Mm-hmm. What has changed, though, is our product offerings have changed. We have, by design, increased the proportion of business that we're comfortable taking that is homeowners, for example. We used to have an upper limit on homeowners value of $500,000. Above that, we wouldn't write the business. In fact, there was a time where we were turning down 2/3 of the business that was coming to us out of just caution. Let's build the business in a methodical way. There's a couple of other metrics that we think about that are important as we build the in-force premium. One, for example, is loss ratio. So if you grow faster, but the business you're bringing in has a greater risk of loss, your loss ratio is going to deteriorate and not be as healthy, or it won't improve as fast as we've seen our loss ratio improve. If we add a certain number of customers in a period of time that accelerates, but our customer experience folks or our claims experience expansion isn't keeping up with something that's new or a new level of demand, that can lead to a negative customer experience, which we don't want. So we're balancing all these so that we maintain the customer experience, continue to see improvement in the loss ratio, and that's been important to us historically, yet drive in-force premium higher. Mm-hmm. So I would think of it as a gradual shift. And as the products available broaden, gone from a single product line company to really 5 different products at this point, 5 different coverage types with a very broad range of price points, that has been a gradual shift over 2 to 3 years.
Interesting. I'm curious how you think about this tension between, let's say, maybe it's not a tension because, I mean, there are a lot of factors, as you mentioned, but in terms of, for example, a typical high growth tech company is going to focus on, the user base first and then monetizing the user base later as a secondary thing and not sacrifice the customer growth. It seems like you guys have a different approach, maybe a more balanced approach with different factors. But I guess the question is I know a lot of your strategy that you guys have shared is dependent on this kind of lifetime value of a customer where their insurance needs will change over time and how you want to acquire the customer. Like, for example, in your Q3 shareholder letter, you said that a central plank in your strategy is playing out acquiring renters at a time and at a cost that incumbents struggle to, then delighting them so that their insurance needs grow, they grow with us. And so it would, on one hand, on one angle, it would just make sense to, go in, all in sense of grow as fast as you can with renters, right? Get the customers and grow with them over time as they get, more insurance needs. And it seems like that would be a little bit in tension with this other angle of optimizing for in-force premium, because now you have to factor in different things. You have to factor in, loss ratio and premium per customer and various, customer service, a lot of different factors. So how do you think about this? Are these opposing? Are these in tension at all? Or, are you able to grow the renters as fast as you can to, build, invest in the future? Because these are, every customer count in a way is a customer who has more and more insurance needs in the future. What are your thoughts?
Sure. I think these things are more complementary than in tension. There is tension in the metrics, right? Fast growth can lead to things that you're not looking to do. Higher loss ratios, adverse selection, which is a kind of an insurance jargon for customers that aren't so great, that may not be great for your business from a profitability standpoint. So there is a limit. We've, I think, done a nice job of growing at fairly rapid growth rates. There's not many insurance companies who have grown at, essentially a nearly doubling rate over the past year for our in-force premium. And in that period where we're growing at very rapid rates, we are seeing improvement in all these other metrics. That's very rare. Typically, those metrics are in conflict. We've been able to show improvement on all those metrics simultaneously. To your specific question, I think the tension the tension versus the complementary aspect is we can do both. We can walk and chew gum at the same time, as we like to say. Our renter base, by definition, will age. They'll season. They'll get a little older. They'll get a little wealthier. They'll start to buy condos or homes. They'll have larger families, and we'll grow with them. And if we keep them happy and our net promoter score is high, we'll retain them, and they grow over time. And we've shared some statistics that show that is absolutely happening. But at the same time, most of the business that we're adding, most of the growth in premium is coming from new customers whose first purchase is a homeowner's policy or a condo owner's policy or now a pet policy or a life policy. Now, many of those folks are also buying a second policy, and so we're checking a couple of important boxes here. But the vast majority of our growth is coming from new customers. So monetizing existing customers is not a primary focus of growth. It's a thing that naturally happens, and this is one of the nice side benefits of acquiring customers young, creating a really engaging and delightful customer experience, enables those customers as they grow to be happy staying with us. and driving that growth where we don't really do much, number one, or pay much really at all for that incremental growth. But our primary focus is to acquire new customers that we can then cross-sell additional product types and fill out the broader portfolio of each of the different coverage types, including the newer ones that we've launched more recently.
Curious, is like you said, the Q4 kind of 6% quarter over quarter customer growth number is perhaps more of an aberration. Do you have any kind of, is the trend of customer growth, is it slowing down? I mean, typically, with a fast growing startup, at certain points, it does, taper off or slow down. I mean, are you guys experiencing that? Is that one of the reasons why you guys are focusing more on in-force premium? Or do you guys, I guess, I mean, where is the opportunity in terms of customer growth? And then I'm wondering also if you can expound a bit on this aberration as like the context or background on why Q4, the 6% might have been, anomaly in the bigger picture.
Well, I mean, one indicator I think is we shared our view of the coming year of 2021. And I think you can see a consistency in the historical metrics. You've seen premium per customer increase at a certain pace. The amount, if you take all the customers, all the premium divided by all the customers, premium per customer has steady upward pressure. And that's, partly by design. We entered the market in a certain way. We've now expanded the product line. And so there's a definite theme or trend that you can see in that metric, and kind of make assumptions about what the future looks like for that metric. And then for customer acquisition, there's also been a changing pace of customer adds. We've added more in certain quarters, less in other quarters. And there's also a gross and net dynamic where you acquire customers and you lose customers, and those paces can be different. And so while I can't really give future numbers yet, other than what we've already shared with the market, I think if you make some assumptions about how premium per customer has grown historically and look at our guidance, we're very comfortable that our view into 2021 is based on everything we know about the business. And I would expect that our customer count will grow nicely, our premium per customer will continue to grow nicely, and that's directly reflected in the guidance that we just shared with the investor market.
Mm-hmm. Got it. Your guidance, I think 2021 in-force premium, was it around 380 million? Is it 300? I forget the exact numbers. Somewhere around there, right?
It was a range.
Okay, a range, yeah. Moving on to homeowners insurance. I mean, it appears a different animal than, let's say, renters insurance. Homeowners insurance obviously isn't as unloved by insurance companies as maybe renters insurance is. Like, and perhaps there isn't this minimum, coverage that you could take advantage of also, with renters. But with homeowners insurance, how much more competitive is it, in that market? And what is your guys' strategy or key insight in tackling that market?
So we found a lot of common themes between renters and homeowners. And if I define homeowners as condo owners and homeowners together for this purpose, they're similar. Price points are different, but they're similar. It's an ownership structure versus a renter. There are lots of folks who are looking for a delightful experience or who have never had a delightful experience in insurance and are pleasantly surprised by the simplicity and the ease of use of Lemonade. There are pressure points in the home buying process, for example, that are quite similar in some ways to the renting process, where you very quickly need to show proof of insurance, where you're getting a mortgage for the first time, and you're required to get something you've never had before. So there's some common themes where you've got folks who, at a challenging time, need to understand and quickly show that they're insured. That happens in both the renting experience and the buying experience. Now, the price point's higher and it's a little bit more complicated, but for most people, the vast majority of the market, it's a relatively straightforward purchase. And we can ask a similar number of questions and bind a policy in minutes. It's a few more questions and it's a few more minutes than a more basic renter's policy. But relative to the typical experience in the market today, more than 90% of policies in the US are still sold through an agent. And through an agent, almost by definition, means you don't start and finish in the same few minutes. It could be a half an hour, it could be a day, it could be a week, but there's usually a process to go through. And so we're able to take people through start to finish in a matter of minutes in what ends up to be a pretty surprisingly pleasant experience. There can be more questions. So your home is, for many people, the highest value thing you've ever had. And so we do have what I would describe as not a tech-enabled human experience, but a human-enabled tech experience, meaning we're getting quite good at knowing how and when to interject a little bit of human support to satisfy a little incremental need that someone might have in the buying process. It also applies to the claims process. And so we have very sharp, empathetic, Lemonade trained customer experience folks standing by that are ready to help if there's that extra added question or concern that is required to be answered before someone's ready to make that purchase. But the vast majority of the sales are happening in a way that's very similar to a renter's policy. And that part, I think, can be a little surprising. I think there was a tendency to think that Lemonade at some point might hit sort of a brick wall where, okay, it's a big lift to go from renters to homeowners. We found it actually to be a much more sort of gradual continuum. It's a little more complex. It's a little more demanding, but the ability for us to translate what we've learned from the renters world to the homeowners world has been very efficient.
Mm-hmm. I noticed with renters insurance, it seems like you guys have led with price. You guys are able to undercut, the competition by a lot. But with homeowners, your team has said that you aren't leading with price. Can you explain why? Is part of that, or is one of the factors that the homeowners insurance category is just more price competitive, and incumbents care about that, or do you guys have just a different strategy where you're competing with the whole package, the whole experience, the efficiency, the claims, the whole process? What's your take?
So our strategy has never been to be the price leader or the discount vendor or the lowest priced provider. Has never been that. It was frequently the result in the renters space of the market because of the factors we talked about, but it was not the sole driver nor the strategy. And so a homeowner who gets a quote with Lemonade will frequently find that we're less expensive, but it won't be dramatically. It won't be 50% less expensive, but it might be less expensive, and it frequently will be. And it might be 10% or 5% or 3%. But there are many cases where it'll be on par. It'll be competitive, and in some circumstances, it might be even more with Lemonade. But the strategy has always been much more around a better experience, more seamless approach, dramatic delight through speed, and empathetic customer support, and very efficient claims management. The whole package, we believe is the critical success factor. Much of the incumbent view of the market historically has been, and you've seen it yourself, is switch and save. 15 minutes saves you 15%. And we didn't want to compete in the same game as others are already competing. We want to compete with a 10 times better experience without price being a factor. And if we can be a little bit less or well less than others, great. But even if we're on par and it's a 10x better experience of efficiency and customer delight, that's a win for us.
Mm-hmm. Interesting. Let's say hypothetically, out of every 10 new homeowners insurance customers that you guys have, what number would be from, let's say, existing renters upgrading, who bought a house or a condo or something, versus new customers? And also, of the new customers, how are you getting these new customers? Is it mostly through paid marketing channels, or is it split between other different channels?
Yeah. So from a ratio perspective, the vast majority would be new customers. We've not disclosed a hard number, but probably more than 90% are would be new customers that we're acquiring versus customers that are graduating. Now, that's shifting because we have a larger renter base. They've been with us longer, they're aging, and so over time that will shift, and that is a good thing. That's by design. But the majority are new customers coming in.
Mm-hmm. And then how is the acquisition channels? How is it broken up? Is it paid marketing? Do you keep track of, let's say, paid versus organic kind of channels?
Yeah, we do, and it's as in every sector, it's a little tricky to exactly pull apart the word of mouth or the organic piece, or the unpaid proportion. But I would think of it as the majority. Well, for paid acquisition, 90% plus is direct digital online acquisition channels, whether it's search, either paid search, organic, whether it's outbound marketing campaigns, call it 90%. And then the balance are coming indirectly through partnership or referrals or structures that we put in place, API agreements and structures where business is being referred to us. So think of it as sort of 90-10, and just in very broad strokes. Mm-hmm. In the direct acquisition piece, it's a balance of organic search. People are searching for renters or homeowners or some sort of insurance, as well as a proportion where we're going out and proactively engaging people in pretty much the channels that you would think of as where the most traffic exists. So whether it's Pinterest or YouTube or Facebook or Instagram, these are the places where we're finding our direct customers. And our conversion rates are very strong. We're able to compete. This I think is notable. We're able to compete effectively with competitors with significantly deeper pockets, larger marketing budgets, because our conversion rates are very high. The proportion of customers that go from entering the funnel to becoming a customer is quite strong, and that enables you to compete very effectively with folks who are able to spend more and have larger marketing budgets, and that's been a consistent theme for quite some time.
Mm-hmm. Okay, got it. With pet insurance, I mean, I know you guys launched in the summer of 2020 last year. Why did you guys choose pet insurance as kind of that your next category at that time? What about it kind of stuck out, and what's your strategy in tackling that market?
Yeah. So there's a few things we think about, and I think it's important to remember the overall strategy. The long-term strategy is we're an insurance provider for consumers. Over time, we want to provide every coverage type that a consumer needs. We're not there yet. We've been in business just over 4 years. We started in a certain sector of the market. We've been expanding. And so we have a pretty ambitious product roadmap internally that we think about. Think about your insurance bill or my insurance bill. We're writing a few checks or paying a few bills for lots of different coverage types. Our goal is to provide all those coverage types so that a consumer can have one provider, and that provider can be eliminated. How we do it and when we do it, we have some optionality. We want to maintain the Lemonade experience. It's a pretty high bar now, so we've created what we think is a pretty great experience, and customers tell us that. And so when we launch something new, we want to make sure it doesn't detract from that. It's got to be as good or better than the best Lemonade experience. That's a very high bar. Second, we want to manage as best we can the whole customer experience. And that is a key part of why we decided when we launched the business, we decided to be a fully licensed insurance company. So we engage the customer, we acquire the customer, we write the policy, we take the risk on our balance sheet. We are a fully regulated licensed insurance company. That's not the case for many of our insurtech competitors, who are great companies, but there's a proportion of those, the majority of those, are a front end or a broker for other insurance companies. It's a good model, but it's not the model that we chose. And so we want to be able to bring the entire customer relationship, start to finish, to the customer. One of the things we can do is pick and choose what we launch when. What we liked about pet insurance was it checked a few boxes for us. One, a relatively untapped market, particularly in the US. There's other countries where the penetration is much higher. It's relatively small in the US, but too rapidly growing. Between the pandemic and pet ownership, there's been a significant increase in sort of pet ownership. When we looked at our customer base, the majority, 60% plus, maybe 70% of our customers we know had pets of at least one or more pets. And probably the most important piece is we felt we could bring something different. Pet insurance has been around for a long time. There are many vendors where you can get pet insurance in the United States. When we launched Lemonade Pet in July, all those customers who bought it from us could have bought it the day before from somebody else, yet they didn't. And that tells us that, okay, something we're doing is working. Something is fundamentally different. One of the things we did, just to maybe put a little more concrete feel to it, is our research told us that it was pretty common in the pet market to think of pets as possessions, as things you were insuring, like a bike or a laptop or a possession. And what was clear to us, and I think is clear to pet owners, is they're not really viewed as possessions. And this is a belief that is pretty common and has only increased, I think, over the past years or maybe decade or so. And so a big part of what we launched was the words we used, the feeling we used, the marketing we used. We came to our customers with a message about pets being part of your family. You're insuring your family, and it just happens to be your pet. And it's a small difference. It feels like a sort of a nuance, but it's one of the things, and I think a core thing that really resonated with customers. And they're like, I get it, I love it, and our conversion rates were very strong. Not only for existing Lemonade customers who bought pet insurance, but we also sold to new customers out of the gate who had never had a Lemonade policy before and chose pet insurance as their first policy type. And then the last piece that was really interesting as well was something like 5% or more of the new pet policy owners then bought a second policy, a renter's policy or a homeowner's policy. So with this one launch in a pretty small market, we were able to check 3 pretty major boxes that were important to us. So that when we went to think about launching life insurance, we now had another set of data, another set of learning, and another set of information about customer experience and claims experience that we were then able to translate to our next product launch. And so our product launch cadence has picked up. We launched, for some time, we were just providing homeowners and renters. Now, just in the past year, we've added, or 2 years, we've added a European product, plus a pet product, plus even more recently, a life product. So we're kind of filling out the scope there, and there's more to go. But we liked the progress we've seen so far in pet.
In your Q3 shareholder letter, you guys said we anticipate pet accounting for roughly 5% of our book of business by year-end 2020, just 6 months after launch. Can you give an update on that? Has it reached that goal yet, or is it getting closer?
It did, yeah. We finished the year at about 6%. So okay. Our estimate was pretty close, but nudged up a little bit. It was about 6%. By the end of the fourth quarter.
Okay, so 6%, is that of in-force premium or?
Yes, 6% on a dollar basis.
Okay.
And important to note, again, and kind of to return to our customer count metric, we were able to acquire a significant amount of business at a price point of about $500 per policy, per customer for pet insurance. And so that's a way with, modest investment, customer economics that are similar to the rest of our business, where we can bring in a fair amount of premium, but the premium per customer is fairly significant, 2 or maybe 3 times what it would be for an average renter.
Yeah. Do you have any expectations on what pet could do in 2021? Is it going to stay around 5 to 10% or so of book?
We haven't really given an indication or a breakdown, but it has been growing at a bit faster pace than the overall. To go from 0 to 6%, obviously, in 6 months means it's growing at a healthy clip. So I think it'll continue to grow at a healthy pace. But we do have this optionality where we can adapt. Where we see better economics, we'll pivot and invest more in those products or those regions or those channels. And that might mean pet accelerates a little bit. If those change over time in a given month or a given quarter, then we'll allow those pivots to happen. And that's, again, why we think of policy count and product type more as outputs rather than as an input that we're looking to optimize.
Mm-hmm. Yeah, I mean, you guys have been on a tear with new products and new geographies the past 2 years or so. I mean, with pet, with life insurance, with Europe, and with Daniel Schreiber sharing that over half the company is now working on a new product. It seems like, there's a lot of growth ideas. Can you, going back to life insurance, you guys launched, I guess it was more of a limited launch, right? I guess at the end of 2020. What's the rollout strategy here? I know you guys have used a partner insurance company. I guess it's North American company for life and health insurance. Is this the first time you guys are doing this? Like actually, partnering with this customer, this partner? Is it a different model? Is it more of a broker model where you're getting commission off as they're servicing the policy, or is it different? Like, what's the kind of breakdown of that?
Yeah, you're right. It is different, but it's not new for us. It's new for life insurance, yes. But part of the way, or I should say, one of the factors we considered when we were building the company and building the platform and the technology behind it is this very thing. We wanted to be able to, when the business strategy made sense to us, be able to sell our own products on our own balance sheet and have fully licensed insurance carrying companies, but also have the alternative to make the other choice, which is distribute a third-party product. And we built the product platform with that in mind from day one. It's to date been a very small proportion of our business that has been through this in this third-party structure, but we have done it. When we launched the business, just as an interesting example, in California, you're required to provide earthquake insurance. It's obviously a very specific market. It's a little quirky. We didn't know much about it. So we partnered with a company called Palomar, which you may be familiar with. And that was a third-party coverage type. From a customer standpoint, it was an entirely Lemonade experience. So the customer's understanding was a Lemonade experience. I'm covered for my earthquake risk. But the policy itself was written by Palomar, and we received a commission. And that structure is still in place today, but the numbers are extremely small, just based on the customer requirement there. So when we got to life insurance, we thought this through, and each time we consider new products, we have this optionality because of how the platform was built. So life insurance is interesting. The front end, the customer decision process is much like other insurance decision processes. Can be a little annoying, can be cumbersome. There's lots of questions. There's process. There's doctor exams, and so we felt there was a real opportunity for us to lemonadize all of that. And the product we ultimately were able to launch truly does that. It's minutes rather than hours or days or weeks to be bound with a life insurance policy, not a quote, but a life insurance policy. It's easy, it's simple, it's clear. There's no doctor exam. There's no waiting period. It's very much a Lemonade experience. But we were able to consider a third party providing it for a couple of reasons. Primarily, if you think about the claims experience is really important in homeowners and renters. It's really important in pet insurance. In life insurance, the claims experience is very different. It's yes or no. Is there a claim or is there not a claim? Because it's life insurance. And the customer is usually not present because they're not the beneficiary. Someone else is the beneficiary. And so because of the nature of that customer interaction, we were able to say we can provide the vast majority of the customer experience, yet not take the risk of writing the policy and giving up on managing those claims. What it enabled us to do is uh, much more speed to market, and we're able to launch it in early 2021 rather than some future date. And there were far fewer regulatory hurdles. And again, our ability to get a product into the market pretty quickly. The economics are pretty much the same. So it's sort of a win-win. We don't give up much at all from a customer relationship or a customer experience standpoint, and we don't give up much at all from an economic standpoint, because for each policy that we sell, we are earning a commission back from the provider that looks very much like the contribution we might get from a customer if we wrote the policy ourselves. So it's for life insurance, all the factors kind of fit together. Now we're not married to this forever. We love our partner. We think they're great. We'll learn and grow with them. We'll see how things go. But we have the opportunity over time, if it doesn't work well or we think we did something wrong, to fix it and change it. I don't expect that to happen, but we always have that option because we built the platform with these transitions in mind. When we look at new, next, future products, we will go through that similar analysis.
Mm-hmm. Does working with the partner insurance company, let's say with life insurance, does that change the capital requirements? Does it enable you guys to be more capital light? Is that a factor at all with the decision?
It does. That's a nice benefit. So for every dollar of premium that we write on our paper, on our balance sheet, which is the vast majority of our business now, we have to set aside a small amount of capital surplus. It's a regulatory requirement. All insurance companies have to follow these same rules. And when we use a third party to write the policy, that third party basically bears the burden of that capital need, that surplus requirement. So yes, every dollar that we write of life insurance will be capital light from that perspective.
Interesting. You mentioned how Lemonade's ambition is to cover kind of all the insurance needs of a customer, of a consumer. I mean, besides renters and homeowners and pet and life, there are various others. I mean, is the ambition truly to cover all the insurance needs? So, I mean, for example, auto, health insurance, travelers insurance. Are you guys open to business insurance in the future? Or is this everything on the table, or are you guys more focused on more consumer-facing insurance?
I think we really have the consumer at heart, and the consumer experience is so distinct from the commercial experience. And the market is so big that we've really focused our sights on for a very, very long period of time. I think really have lots of running room in the consumer market. And so that's really where our focus lies. There are aspects of the commercial market that start to look a little bit like consumers that we think are interesting. So very small businesses, single proprietors, self-employed folks, commercial coverage for those types of needs look not too different from a renter's or a homeowner's insurance policy. So there's probably a little blurring of the line there where the buying experience looks very much like a consumer buying experience. Absent that, though, I think it'll be really focused on consumers. Health insurance is a tricky one because that's a level of complexity. I think that's a different level. But really, all the types that you mentioned are of interest to us.
Specifically with auto insurance, I mean, this is insurance that so many people have, driving a car, etc. And it's a huge market. I mean, what are the challenges in getting into market? I mean, it seems like it would be a hyper competitive market. Tons of insurance companies vying for attention, lots of ad spend, high customer acquisition. How do you guys, in a hypothetical entrance into that type of hyper competitive market, how do you guys stand out? And have you guys been thinking about the more competitive markets over time to enter them? And how do you guys weigh this? I mean, it's a bigger market, maybe bigger opportunity, but then it's also perhaps bigger competition. do you guys what type of strategy are you guys refining, and developing to enter those type of markets?
Um, well, we don't shy away from competition. The markets we're in I would argue, are quite competitive, and so that doesn't trouble us. Now we're also not naive to think that all markets, even within insurance, are equal. So your points are well taken. We'll use a consistent lens that we used in the past, which is to launch a new product. We need to believe that Lemonade is bringing a fundamentally different experience. If it's a Me Too experience, if it's an almost as good as experience, if it's a we're as good as the average experience, that historically has not been interesting to us. And that's, I think, step one. We need to convince ourselves that we can be markedly better, a markedly better customer experience. Two, we also note that what's important to our consumers is important to most insurance consumers is bundling. Bundling is important, and I should be clear to say that bundling, in my view, doesn't equal discounts. Bundling often does mean discounts, meaning there's added value to have multiple policy types. Good things happen when people have more coverage with one vendor. They tend to be, in some cases, more responsible. They tend to have longer lifetimes with the company, greater retention, more loyalty. And so we recognize that. And our customers are no different. It's common to desire fewer vendors versus more vendors. So that's something we don't ignore. But the customer experience has to be there, number one. Two, data is critical. We believe that we've gone from a data disadvantage to a data advantage in the businesses that we're already in. We collect a lot of data per customer. We leverage that data in a lot of very thoughtful and also economic ways. Your example of car insurance is very data intensive in a good way, meaning there's quite a bit of data to collect and leverage. There's new technologies that are being adapted and used. Telematics, we think, is a really important driver in how to bring a better experience. How do we leverage data and improve upon the process of underwriting, improve upon the customer experience, and bring a better product? Having more and better data, that really fits into Lemonade's wheelhouse. So the parts are there. On the other hand, we have our hands full with what we've built and launched recently, and we've got a lot of running room with those. So we don't feel compelled or forced, but the long-term vision, again, as you stated and I stated, is to provide all the coverage types that our consumers want.
Got it. With data, in the past, you guys have mentioned, like, when a customer is onboarded to Lemonade, a new customer, incumbent typical insurance companies might only use 30 or 40 data points, but you guys use 1,700 data points. Can you expound, like, how is that possible? Because it feels like on one side, it's not like you guys own a social media experience where people are browsing hundreds of hours, per month on it, and you guys understand everything about their life. It seems like when a person signs up, they have a limited time in the app, right? So how much of that data, of those data points, let's say the 1,700 data points, how much of it are you gaining just by, tracking what they're looking at or browsing or how they're filling out the application versus external data points where you guys are, bringing in stuff outside of the app experience? And of the data that you guys are bringing in from outside of the data experience, like, where is this data coming from? Is it purchase data from other sources? Is it a combination of stuff that you guys are, bringing up yourself? Like, is there any way you could kind of expound on this data advantage that Lemonade has?
I can, and this is, to some extent, this is a bit of our secret sauce, and so this is one where we can share some, but not quite everything. Most of the most valuable data is the data that we collect through the experience. We do use third-party data. Every player uses third-party data to some extent. Some use it better than others. Not all systems are created alike. We have a system where a given set of data can have more value in a wholly integrated, built from scratch system that's 3 years old than that same data might have in another system that does not have those benefits. So data is not data, just is probably one point to make. But the most valuable part is that 100% of our customers go through the same process using the same system, and we collect the same depth of data for all of them. So we're not only getting a deeper view of each individual customer, we're getting a deeper view of the customer base because the data is consistent across every customer at great depth. And what's interesting is in the 1,700 data points, there's not only the data that we know we want to collect and react to and think about and analyze and draw conclusions from, there's also the data that we don't know why it's interesting or important. We just know it turns out to be, using AI, interesting and important for everything we do. And by virtue of having 1,700 data points versus having 30 or 50, which is more common in an agent-based environment, enables you to take the basic premise of AI and leverage it by a dramatic multiple and find those patterns, find those distinctions, find that granularity that enable us with just 1 million customers to do things that are difficult to do when you have 10 million customers or 50 million customers. And maybe just to hone it, sharpen it a bit, if we think of 2 potential customers that on average or on a superficial measure or on 20 data points look very similar. Same demographics, same age, maybe same address or neighborhood. With 20 or 30 data points, they kind of look the same. Those 2 very same people with 1,700 data points look radically different to us in almost every way because of the scope of the data. And what it enables us to do is just about everything can be different. Now, you can't necessarily dynamically price because we're selling insurance and there's price restrictions in insurance. But just about everything else, we can have a deeper understanding of those customers and their risk and their behavior and their expectation of loss and their risk score, which is something we've developed, which is a measurement of all those things I just described, their risk network. So they associate with certain people, they have certain affiliations. All of those things tell us something about the risk of those 2 people. And the net of all of that, customer A, in my example, might have an 8 times different expected risk or loss than customer B, where in a world of 20 or 30 data points, they look almost identical.
Mm-hmm. I mean, it's interesting. It's fascinating, using data to assess risk. I mean, what would you say to the person who's like, what? But you get the data, the sign up process is so quick, though. It's just like a couple of minutes. Like, how can just a couple of minutes produce so much data? And is it really deep data, or is it just more shallow data? Or on the flip side, like, are you guys noticing some certain points, like for example, when the time of the day they're signing up, like how long they take on different questions or certain things? Are you guys noticing certain things that's just having an abnormally big impact on the risk profile of certain customers? Like, how is it that you're able to take such quick user experience and get so much data that is actually valuable for the sign up process?
So it's an interesting. It's exactly the right question, because when I first started with Lemonade, I struggled with this same question because it takes a minute to think through. There's a real amplification effect or network effect that happens here. So one customer with 1,700 data points versus one customer with 30 data points. Well, 1,700 seems better, and it is in the ways I just described. Where it starts to get much more interesting and a little more kind of moves you from, wow, that's great, to more like, wow, that's a fundamental difference, is the amplification of that. And it gets amplified in a couple of ways. One, just the quantity of data grows at a much more rapid pace. 1,700 versus 30, kind of multiply that out by customer growth, and you can see where that changes. Two, we're leveraging that data advantage on a unit basis by using a system which is itself fully integrated and built from scratch on a data platform. So we have one system that does everything that our business does and has visibility to everyone in our business that needs to have visibility. And so what that means is we are seeing a potential customer turn into a customer, quoting, binding, customer support, customer inquiry, payment, non-payment, claims management, risk profile. All of that is happening in our company in one system, built from scratch by one team in the last 3 years on the latest technology. So everything that's happening that's interesting is not only interesting, but it's available and leverageable in real time to all the people who need to know. And so our ability to react to something that happened yesterday, today, and take an action that has impact tomorrow is extraordinary. To us, it's just normal. We upload code, and basically, which means we basically change our product, make small improvements and modifications to our product that affect customers, not always visible to the customers. We do that 20 times a day, every day. And so small advantages that we can evaluate and turn into small benefits in a day or a week or even a month, that's a radical difference compared to just about everyone in this market. It's pretty common to change your product never in this market. Sometimes it's once a year or twice a year. That advantage of being able to collect more intensive data, evaluate it in real time through a system that's built to do it, and take action, that's a very short loop that starts to spin and cascade and drive really dramatic improvements. Mm-hmm. And then the last lens on that is we're collecting and storing this data. Not all of it is helpful and useful yet. But as we expand our coverage types, we're finding things we didn't know we now know. So I've got a customer base. Now I know a little bit more about what does their behavior around pets and pet health mean for a renter or a homeowner. Didn't have that 6 months ago. Now I have that. Now we're going to start to learn what is the life insurance buying and thinking process? What does that mean to the rest of our business? And then that can flow through our flywheel loop in a day or a week, whereas most of our competitors, it takes a month or a year. And so all of that in aggregate, it's sort of a long meandering path there, but it's not just 1,700 data points versus 20. It's 1,700 data points versus 20 through a consolidated system, through a broadening profile of customer usage. All of those in aggregate create this flywheel that just accelerates on itself.
Okay, got it. I'm wondering, I noticed I've gone through kind of iTunes Lemonade reviews personally, and you guys get great reviews from the app. When there is a negative review, oftentimes it's with the claims issue where they feel like it's something that they thought was covered but isn't covered, right? And they're disappointed. And whether it's a lack of communication or they just didn't read what was excluded, et cetera. And when I was kind of thinking about that, I was like, do you think there is a way where, I mean, does Lemonade have the ambition to give coverage that is actually better coverage, meaning less exclusions, where it's a broader set of, just better coverage to differentiate your insurance? And the second part of this question is, does your relationship with reinsurance kind of tie your hands behind your back where you're not able to change the exclusions or give a broader set of exclusions to your customers? What are your thoughts?
So maybe answer the second one first. Is reinsurance doesn't really tie our hands. We have the ability to do the things that we need to do and want to do to create a great customer experience. It almost never comes into play. It's essentially invisible from a customer viewpoint. Now we have to deal with and manage the reinsurance structure. We want to build a healthy book of business with a strong, well-performing loss ratio or claims frequency, so that that's a healthy relationship. But that's really for us to manage with our reinsurance partners, and we do that quite well. From a customer standpoint, we have tested these areas. We have done exactly what you're suggesting, and it's an interesting one where we found that customers are willing to pay for things. Customers are willing to pay for things. Let's put it that way. So there are folks for whom, deductible is a pretty confusing term for first-time insurance buyers, and being told, well, this is covered, but that's not, or you got to pay for the first. It's still a kind of a weird thing to explain to somebody who's 20 or 25 buying insurance for the first time. And we have found that there's a subset of folks who are willing to pay for no deductible. And even though the decision may be less economic, it may not be a wise financial decision in your view or my view, for that customer, it's the right decision because they're buying not only the financial benefit, they're buying the mental benefit. They're buying comfort or confidence that something they think is covered is actually covered. So we can do those things. We have tested those things, and we have the flexibility to do those things. I wouldn't classify them as huge fundamental drivers, strategic drivers of the business. But again, our platform is flexible enough, and our communication with customers, I think, is clear enough and empathetic in nature that I think we have the ability to leverage that as much as any player in the market. We do get, on your question about denied claims, we do collect our net promoter score. We ask people how they feel about it because we want to know. And while the customer rating or the net promoter score in a denied claim is significantly lower than otherwise, for Lemonade, it's dramatically higher, significantly higher than peers. And so the relative measure is what's important. And that's something that we do track. In fact, in our Texas experience, one of the things we did a nice job in is in a very short period of time, in a very intense experience, we had to explain empathetically to people what they're covered for and what they weren't covered for. And the reviews, while no one gets 100%, positive reviews, our overall performance was very strong, and our reviews from customers were very positive, even in cases where claims were either not truly claims or where a claim had to be denied.
Cool. Got it. I wanted to go through unit economics of Lemonade. I know it can be a bit confusing with the terminology and the different layers, but I'm wondering if I could kind of walk through kind of my understanding of unit economics,
Sure.
and you could kind of chip in to see if, things need to be clarified or if I'm misunderstanding. So let's say we have $100 of premium collected, hypothetically.
Yep.
So off the top, it seems like about 2.5% or $2.50 of that will go to some type of blanket catastrophic kind of insurance. Is that kind of a correct understanding?
Rough strokes, yes, that's
Okay.
right.
And then is this one insurance company, or is it a set of insurance companies? And what does that catastrophic insurance really cover?
So we have a couple different types of reinsurance. The catastrophic that you're referencing is one of those types, and we have multiple providers. In total, for all our reinsurance, we have something like 10 or 12 different providers at different proportions. The one that you're describing, which is a specific type of catastrophic coverage, is if the amount of loss in any one instance or any one location is significant, like over $500,000, for example, there would be coverage that would kick in that we would not be liable for. So that's in a low probability but high cost scenario. And so that's that first coverage type that you mentioned.
Okay, got it. And then the rest, so $97.50 or around there, you take that premium, and then 25% of that, so let's say about $24 or so, Lemonade keeps, and they're paying 25% of the claims, or of the claim liability, I guess, from that 25%. So about $24 in total premium, and after they're paying, I guess, your share of 25% of the claims, the rest is kept as gross profit for operating expenses. Is that kind of generally the sense of that 25% that you guys keep initially? And then you give 75% of that $97.50 to reinsurers. But then reinsurers, the reinsurance companies, they give you 25% of commission. Is that also generally the sense? So so basically you're giving them $73 of, let's say, the $100, and then they're giving you back $18 around there for your commission, in a sense. Is it $18? I'm not sure. Maybe that's a little bit off. But so then the reinsurers are left now with around $55 to cover 75% of the liability of all the claims out there. And so in order for that $55, it seems to cover the 75% of liability on the claims, it seems like the loss ratio, according to my calculations, needs to be like 75% or less than, a little bit less than 75% for the reinsurers to break even. If it goes lower than 70%, then they're going to be able to make more, I guess, off of that $55, right? And then on Lemonade side, you combine the $18 of commission from the reinsurers or so, and then you combine that with the leftover money from that 25% that you guys kept after paying, your claims liabilities, maybe $8 or so. So you guys are left with maybe $25 or so of gross profit, which then you guys use to pay operating expenses. I mean, that's generally what I'm getting, but where am I kind of, not clear or not getting it?
I think you have it just about right, and I can maybe even help simplify it a little bit further, which is whether a dollar of premium is kept by us, retained by Lemonade, which is the 25%, or if it's ceded or given to the reinsurance partners, which is the 75%. Either way, it's about the same economic impact on Lemonade. And your example, I think, was right on. The math is a little bit different on the way down, but basically, after we pay claims, we have about a 25% contribution. When we cede premium or give premium to the reinsurance partners, we get back a 25% commission. So either way, we're retaining about a 25% contribution from which we then run the rest of the business. Mm-hmm. And that's really the fundamental or part of the fundamental reason we put this structure in place. It gives us protection if there's any volatility in loss ratio, and loss ratios can be volatile. So if in a given quarter the loss ratio spikes, 25% of that spike will be borne by us. Likewise, if the loss ratio improves significantly, 25% of that benefit will be kept by us. But 75% will be borne or kept by the partner. Mm-hmm. So that gives us protection if the loss ratio is volatile. And you're right, if the loss ratio is about 75%, the reinsurers will about break even because they're paying us 25% commission to us. They've only got 75% left. If the loss ratio is 75%, they're about break even. So that's exactly right as well. Mm-hmm. The last piece, which is important to note, I think, is why are we doing all this? Well, one reason is to protect us when the loss ratio is volatile. The second reason, and probably a more compelling reason, is it reduces the amount of capital we have to set aside. So again, it's another way of making us a capital light business, similar to the earthquake example, the life insurance example. We don't have to provide the capital surplus for the 75% that we're giving to our reinsurance partners. So that's another benefit. Reinsurance it's a little complex. You have it, I think, exactly right. You're in your example. When we put this structure in place last July, we had the opportunity to go without, to have no reinsurance. That would have been a reasonable choice to make. which we considered, we did not make the choice. The reason we chose to go with this structure are these benefits that I described, and we got the terms that we were seeking. The commission rate is a pretty reasonable and solid commission rate. If our loss ratio improves above a certain point, or rather below a certain point, we get a benefit in terms of a slightly higher commission in those cases. So we're able to get a structure that protects us. It's in place for 3 years, which we like. And it protects us economically in the way that I just described.
Yeah, I mean, I think I forget what interview you're saying that by having reinsurance, it significantly reduces the amount of capital reserves you guys are required to hold, right? Can you explain a little bit more about that? If you didn't have reinsurance, for every dollar of premium, how much maybe would you need to keep on your balance sheet versus having reinsurance? How much are you able to keep?
Sure, and to be, it's probably worth noting that a year ago when we put these structures in place or began to work to put these in place, our capital structure was quite different. We were a private company. We hadn't done a capital raise at the IPO. We hadn't done a secondary offering that we've just done in January. Our balance sheet looks very different today, and our risk profile looks different today than it did a year ago. So that's worth noting. That said, setting capital aside, which you can't use, generating a very low return, is something, if you can minimize that, that's a good thing for your business. You can free up capital to do other things, to drive higher returns, to drive growth, all the other things we're doing. In broad strokes, without this reinsurance structure that we have in place, we would be required, and we were required, to put aside about $1 in capital for every $3 in premium that we sold. Every $3 in in-force premium, 1 to 3. After this reinsurance structure was put in place, that 1 to 3 ratio improved to 1 to 7. Now we have to put aside $1 of capital for every $7, roughly, of in-force premium. And that 1 to 3 going to 1 to 7 is really driven by this proportional reinsurance where we're sharing the burden with our reinsurance partners.
Got it. In Q4, your latest earnings, it showed that you guys had about $50 million in gross earned premium, but the adjusted gross profit was $9.5 million. So that's about 20%, it seems like, gross profit. What happened in that case that it's different than, let's say, a 25% gross profit?
Yeah, so there are other factors that affect gross profit. And so that can vary quarter to quarter depending on other things. There are other costs, including payment processing costs. So, for example, we enable customers to pay using a credit card on a monthly basis. That's a different payment processing cost than if they paid by, say, check once a year. So that can impact our gross profit. Investment income. Today, interest rates are very low. A year or two ago, they were higher. That interest rate variation can affect, and our bank balance, cash balance, invested balance, can also impact gross profit. And then the third primary piece to keep an eye on is our commission income. So a third-party commission can also impact gross profit, but it doesn't affect your in-force premium or your earned premium because it's not a policy that we're writing, a third party is writing it. So while our gross profit is high at 20%, it can be higher over time, and those are the factors that will drive it to different ranges versus where it is today.
Got it. And how much does loss ratio impact the gross profit? I mean, I'm assuming that if your long-term kind of goal is 60 to 70% loss ratio, then would that increase kind of gross profit? And if so, do you have a target of what you're expecting?
Yeah, in broad strokes, the gross, one of the metrics we report is our gross loss ratio. And that's the total losses and the cost of managing those losses divided by earned premium, gross earned premium, not in-force premium. So that's one important distinction. That gross loss ratio impacts our gross profit proportionally with our reinsurance structure. So if we had no reinsurance, all of it would impact our gross profit. It would be not dollar for dollar, but it would all impact us. Because we share or cede 75% of our premiums and our losses with reinsurance, only 25% of that loss ratio variation impacts our gross profit. So in a very basic example, if there were a 10-point change in gross loss ratio, you'd see a roughly 2.5% change in gross profit, either upwards or downwards, because of that. In terms of a target, we are currently roughly at our targets, our target loss ratio. And I would think of it this way: while we're past the point where we need to show dramatic improvement. 2 years ago, our loss ratio was very high. We had to show dramatic improvement, and we were able to do that even while we were growing very rapidly. That was, I think, a pretty great, impressive accomplishment. We're in a new stage now where we're optimizing within a range. We're growing rapidly still, and therefore we're bearing what we would describe as a new business penalty. New business, by definition, usually has a higher loss ratio. So things that are new, they're not optimized, you're learning, there's not as much data. So we have a higher loss ratio for homeowners than for renters because it's newer. We have a higher loss ratio for pet insurance than we do for renters because it's newer. And so our target is to be in a range where it's healthy for the business from a gross profit standpoint, where it's comparable to peers in the market. Average competitor loss ratio in the business, something like 72%. If you take all the top P&C players in the United States, so we're kind of at that range. We've been at 72, 73%. So we kind of check that box. We want our reinsurance partners to be happy, and so that 75% marker is an important one. So I would think of that range of below 75% over longer periods of time. And then in any one period, short periods, you could spike outside of that range. So a month or a quarter, you could see spike above that range. Q1 is likely, as we mentioned on our call, Q1 we're likely to see that because of Texas. But I would think of that, better than 75% over the longer term as a target range, and we've been there for several quarters.
I wanted to ask about your marketing kind of approach, where I know in an interview with Barclays, you were saying how, for example, for every dollar of customer acquisition cost. So I guess I wanted to work out the unit economics of marketing, for example. So let's take a hypothetical, actually $200 premium, in-force premium per customer. And let's say hypothetically, you're getting a 25% gross profit off of this, customer. So that's every year, that's $50, right? So in 2 years, that's about $100. Should we use 20% or should we use 25%? What's your take on kind
of? Over the longer term, 25% is a more appropriate number because we've shown improvement or growing to that range. 20% is today's number, and some folks who want to be more conservative use that number, but they're both reasonably accurate.
Okay, so if you're targeting a $200 dollar premium customer, in-force premium customer, let's say over the course of 2 years, they're going to give you about $100 worth of gross profit or contribution. So then you're able to spend $100, let's say hypothetically, to acquire this customer. In order to get a payoff of 2 years. Is that kind of how you guys are thinking about acquisition?
Well, your math is right. We think of it slightly differently. We think really of the lifetime value. The payback period is important and something we kind of track, but we're really more focused on the lifetime value. What are we ultimately going to deliver? Because if your payback period is if your payback period is long, but the lifetime value is significant, that's a good trade-off. And vice versa, if the payback period is short, but the lifetime is not long, that's not necessarily a good bet. So we think it's important to look at both. We're paying a little bit less than $100 to acquire $200 of premium. So in your example, we're actually doing better than that. We're paying, the ratio is about 2.5 to 1. So for spending $100, we're getting about $250 a premium versus 200. So we're doing a little bit better than that currently. And then another thing that happens is it's pretty rare that someone's premium remains unchanged. So even a renter, for example, who's a new customer that stays with us for 3 years, even if they don't buy another policy type or they don't graduate to a homeowner, they typically pay more over time. They become wealthier, they need more coverage, their premium increases. And so that metric for us has been something like 50% increase over those 3 years without any other change. And so that shortens that payback period. If they graduate to a homeowner, that shortens the payback period dramatically. That's a small proportion of folks, but it's growing. And if they buy another policy type, so if they buy life or pet and hopefully additional things in the future, that shortens that payback period. But your fundamental math is the right starting point.
So the 2.5 ratio, is that the ratio of the cost of acquisition over the premium? I mean, compared to the premium that you're getting for that, or is it the lifetime value that you're getting from that customer?
They're actually quite close.
Okay,
they're not exactly the same, and over time, the lifetime value should, if we were doing our job right, should increase faster. But it is not uncommon in insurance that the lifetime value and 1 year premium are similar in ratio. So not always 1-to-1, but similar and that's because of the dynamics of the gross profit margin and how much claims usually cost versus premium.
Got it. And I'm guessing across different product lines, you guys are seeing different variations, right, of these ratios. Is there a certain area that you guys are finding disproportionately more attractive in terms of cost of acquisition than other areas?
We're seeing good results in all products, which is why we're seeing good growth in all products. It's more variable by channel and by region. So, for example, and again, we're optimizing because we tend to optimize for premium and not for product and not for customer count and not for geography, that those will move around as we learn and as we deploy growth capital. So in a given month or quarter, this channel may perform very well, channel X might perform very well, and the next quarter it's not performing well because something in the competitive dynamic has changed. And so those adjustments are constantly being made, and but they're being measured, and where the return, where this ratio of 2.5 to 1 is changing. If it's 3 to 1, we're going to do more of that. Where it's 1 to 1, we're gonna second guess that one because either something's wrong or something's changed. And so overall, when I say 2.5, that's an overall metric. But if you isolate any given customer, the range is much broader. And how we know we're doing well is that 2.5 kind of overall view. A year and a half ago, that was 1. And a year ago, it was 1 point something. And now it's 2.5. And so while that pace of improvement was pretty dramatic, it's probably, we don't assume that's going to replicate. It's hard to double that again. Each incremental improvement, that ratio gets a little bit tougher. 2.5 is good. 2.5 or 3 times, that's really good performance.
That's a dramatic, increase in marketing efficiency, right? To go up from 1 to 2.5. I noticed in 2020 versus 2019, the 2020 marketing spend was actually less than 2019, year over year. But also quarter over quarter, last Q4 versus 2019. If your marketing efficiency is improving at such a impressive pace, why is your marketing spend decreasing year over year?
So that change is as much an indication of the prior year inefficiency as it is the current year efficiency. So what that tells you is we were spending a lot of money at a ratio that was good for the time, but not nearly what we're doing this year. And so this year we were able to acquire significantly more business at fewer dollars per dollar acquired. So a significant improvement. And if you look historically at multiple years, you'll see that dynamic didn't replicate itself every year. And so that was sort of a turning point where we were growing rapidly and our marketing efficiency improved dramatically. And that was a sort of a unique anomaly. And the second driver is really we typically don't choose to acquire unprofitable business, meaning we could have spent that incremental dollar, but where we see it bumping up against our efficiency, our sort of return on investment targets, we'll dial back that spend and not acquire business that we think is going to struggle to be profitable at that cost. And so you'll see those sorts of anomalies.
Mm-hmm. Got it. We have a viewer question. Transform Investing says, what are Lemonade's targets for the number of customers, revenue, and profitability by 2025? I had a couple other questions from viewers. They're asking kind of like, do you guys have any 5 or 10 year kind of longer term, vision in terms of, like, for example, Tesla had this whole thing of Elon Musk wanted 500,000 Model 3s, delivered by 2020. This was, 8 years ago or something. That kind of gave investors a longer term idea of the ambition and scale of what Tesla was achieving. With Lemonade, do you guys have anything in that type of longer term time frame of, hey, we want this many customers or this much premium? We want to become this type of insurance company in terms of concrete numbers?
Yes. So we've been very clear about what we want to be, and that is a fully digital leading global consumer insurance company. That is crystal clear. You can be very large and yet be very small in terms of market share. And I think you and Daniel had a chance to talk a little bit about there are $100 billion, 100-year-old insurance businesses that have 4 or 5% market share. So we believe that this market is ripe to build a very large digital-first insurance company, and that no one's ahead of Lemonade on this score. And we really believe we have the pole position. What that hard number is, we've not assigned ourselves yet externally. I would think of it this way. We're in a tough market in 2020, in a pretty tricky year. We almost doubled the business. We gave our guidance for the first time for a full year after being public for 2021, where with pretty significant growth rates. And that's our guidance, that's our expectation. Historically, we've done, I think, a pretty credible job of attaining our own expectations, and in some cases exceeding them. And we'll see how that plays out. We can show those growth rates again and double again and double again and double again for a very long time because of the sheer size of this market. And that's really the ambition, is add these additional product types, become a very large player, grow as fast as we can add healthy business. What we won't do, and part of the reason we want to be a little cautious about the Elon Musk number, is we have other things that we keep in mind. Customer satisfaction needs to remain high. You can't grow so fast that customer satisfaction drops or the customer experience deteriorates. That's a product killer. It's a company killer. Loss ratios are important. We've grown very rapidly, yet improved our loss ratio. We've really struggled to find other insurance companies historically that have been able to do that at the pace we've done it. We've not found those examples. That's a unique result. We don't want to grow at such a pace where that can kind of reverse itself. So we want to be cautious about that. But those are really the throttle points that we think about. And we're in markets where if we can accelerate growth, we have the opportunity to do that. We think we're laying the groundwork and accelerating the product roadmap. We talked a little bit about new products coming, which we haven't really talked about to that extent before. To give you that's our indication that we're thinking, quite ambitiously.
Yeah, definitely. I mean, I can't wait for this new product that Daniel Schreiber has hinted about, where over half the company is working toward. I mean, it's going to be interesting. I mean, is this something that investors should think about is super long term, like it's going to launch like next year, or is it something you think that you guys might be able to pull off this year, by the end of this year?
We always have ambitious goals.
Yeah.
I'd love to be able to be a little more specific.
Right.
But we have the capital now.
Yeah.
We raised a little bit more money recently. We're leaning in. We're hiring, a little bit more versus a little bit less. And we're trying to share a little bit more information, each month as we go, each quarter as we go. So we have the same goal. We want to tell people about what's coming when.
Yeah.
But I'm gonna put a pin in that one until we get a little further down the road.
Awesome. Tim, I want to thank you so much for just extending your gracious time and just sharing freely and really, going through lots of different aspects. I know I've, covered so many angles, but you're just fantastic in just your sharing and just being gracious. So on behalf of myself, but also all the viewers on my channel, et cetera, we want to just thank you and appreciate your time.
Well, thanks so much, Dave.
Okay.
It was a pleasure.
All right. Thanks. We'll see you. Bye.